Hello, and I hope everybody had a good weekend. We're going to start the weekend review first with the SPX. We have once again tested down into the 38.2 of the tertiary at 68.1880 and still supported by the put wall at 6,800 as well. This has held the last 4 attempts at price. And on each reversion of this, or of each test of this level, we were able to cause a mean reversion back to the highs. To retest the 7,000s and then to retest the extension level at 69.58, which has basically been harboring price from the advancement here. From here, we'll look for a potential bounce up into 69.17 as R1 and R2 again up into the box. The risk here, of course, is a failure to hold 68.18 to 6,800. Which then would offer a rotation down into the 67.05s. Losing this high volume node up here is also going to create a bit of stress. If we do break below that 6,800, it's going to create a lot of supply above price, which is going to be harder to overcome and likely can push price lower. And I just say that because of the amount of volume up here, right? We have 200 and, let's just do it this way. We have 173 billion contracts traded on the SPX since November to current. That means that half of those people are long and half of those people are short, which means, we're going to have to have a sell-off of, about 80,000 to 85,000 contracts, or 85 billion contracts if we breach that 6,800. So that's going to be the issue, if that's the issue. And it works the same way above. I'm not trying to be all gloom and doom. You break up and through 69.17 and you can hold and then you lock out and then you can drive up. I mean, that's the same way, right? If we break down, longs have to cover. If we break up, shorts have to cover. Breaking up offers you call wall at 6,100 and then the double fib at 71.40 to 71.66. Breaking down offers 67.05 and then lower. Potentially into 65.21, the previous low, and even, 6200s if you want to be crazy, but I'm certainly not getting that far ahead of myself. But for now, it's just consolidation. We have really odd situations where we see some stocks rotating 7 to 10% a day, and the S&P is up 1 or 2%, and then we close the day flat. It's a very odd time for volatility, whereas on a long-term volatility there is none, but in the intraday there's all of the volatility. And I can't really remember a time where trading was like that. So it just kind of has me sitting on edge a little bit. Obviously this can break up just as easy as it can break down, but just given the current climate of tech heavies not doing so well, I think that breakdown is the risks if we start to see those components that are holding the market, like your financials, for example, or your energies, or your industrials. Like, if any of these that have created the drive in the market, if they start to give, then we're going to have some issues, right? But for now, the way that everything is weighted in the SPX, essentially, the weakness in the tech stocks housed in XLK, XLC, and XLY are being held up by energies, financials, defensive stocks, etc., etc. And so that's what's creating this lack of range in the SPX, but is driving all of that intraday volatility.